I would say most of it is really earnings growth. Number one, it's really 5 reasons to be constructive U.S. equities, I would say. Number one, a very, very clear V-shaped recovery in S&P 500. EPS growth has been taking place since Q1 of last year. So we were at -7%, -3%, +3%, looks like +7%. And we should get all the way up to +12 or +13%, which is our earnings forecast, number one. Number two, I would argue somewhat more controversially that we don't see equities on an absolute basis as particularly expensive. Sure, the multiple is higher than the historical average, but if you think about the multiple in terms of its historical drivers, it's exactly in line with where it should be. The multiple does fluctuate over the cycle. We are later in the cycle. The multiple should be higher. The third point that I would make is, equities on a relative basis are very, very cheap. So very common, typical measure that people talk about is the equity risk premium. If you think about where the equity risk premium is today, and you compare it to where the equity risk premium has been prior to this cycle, the last time we were at levels like this prior to this cycle was back in the 1950s. So equities are very, very cheap. Number 4, I would say, and we talked a little bit about buybacks, that's a strong, steady bid for equities. Argues from a demand-supply point of view, you should see 10 to 12% from buybacks alone without any inflows. And of course, after 2 years of outflows from U.S. equities, there's very good reason to believe we should get some inflows, especially as growth's picking up and earnings are picking up.
So, 2 things that strike me there, or one is it doesn't sound like any particular policy out of this administration, whether it's tax cuts or fiscal stimulus, is baked in or needed to hit your target. And as a follow-up to that, people have been asking, why doesn't the turmoil out of D.C. affect things? Why do markets seem so unfazed? People ask that all the time. They probably ask you that. What's your answer?
They do. So on the very first question, I haven't baked in any policy changes because we don't know exactly what they will be. Right. I think many of them, such as deregulation, in my view, are unambiguously positive, or you don't really need deregulation. You need just a slowing in at the pace at which regulation was growing. And there, I would argue the historical evidence is very, very clear. The magnitudes are difficult to tell, but like I said, not only earnings growth, but GDP growth's been coming back very strongly too. And so it just reinforces that view. It increases the confidence in that view. I haven't really baked it into, that it's going to do even better, but it could well do that. In terms of, and I haven't baked in the policy changes because I think, many of the narratives about what they're going to be and what has been proposed tend to be quite different. I mean, if you take corporate tax reform, for example, a lot of people expect that we're just going to get a lowering of the tax rate. But that's, not what's been proposed. What's been proposed is a lowering of the tax rate that is to be paid for by a cut in or elimination of the interest deductibility and then a border tax. That's a revenue neutral tax increase that doesn't strike me as necessarily being positive and has a lot of risks in the transition process.